mutual funds. So we're going to talk about Islamic investing according to Islamic principles, and we're going to also talk about a few in-year tax strategies. As we know, it's coming up to the end of the year. We're going to talk about some ways where you can actually save money on your taxes, but at the same time also help Muslim organizations like the Mesquite here. So the important disclosure, so one of the things we always say that investing incurs risk. So there's no guarantee of return. So when you're investing money, you're putting your money at risk. So why do people save?
Yeah.
We stay at home, yes. Anything else? For their kids, for college. You know, a lot of times what we see also is that people are saving for Hajj. The price of Hajj is going up. I think it's almost $8,000 to $10,000 now. So some people have to save that up. And so saving is great, but if you can save and have that money work for you, it's even better. So the first we're going to talk about investing for college. We're going to say why is it important to invest for college. We're going to talk about a couple of different accounts where you can invest for college. And then we're going to move on to retirement, and we're going to kind of do the same thing. So investing for college, you can see that the cost of a 4-year private school has gone up almost a double, from close to $20,000 in 1990 to almost $40,000, and that's for 1 year. But the price of in-state tuition has actually almost tripled, from $3,000 to $11,000 over that course of the same time span. So you can see that the price of college is rising even above the price of inflation. So the public 2-year college, you can see that's kind of remained constant over the last couple of years. And so look at the average debt. So over the last 30 years, you can see that the average debt went from $9,000 in 1993 to almost $29,000. And remember that $29,000 because we're going to get back to it in a later slide. So now I said we're going to talk about 3 ways to save. So the first one I want to throw out there is a 529 plan. A 529 plan, I think a lot of people are familiar with it. This is a state-sponsored plan. So every state is going to have a 529 plan. The thing about the 529 plan is when you're thinking about Islamic investing, when you have more choice, that's when you can make it permissible or Islamic. You know, there's a lot of investings where you don't have too many choices, where you have 2 or 3 options. So the 529 plan, one of the pitfalls is that you don't have that many options to invest in. Usually there might be 3 or 4 options. But the good thing for the 529 plan is there are no contribution limits, and there's also no salary limits in order to open a 529 plan. Second, we want to talk about the covered all ESA, or Educational Savings Account. This account can be used for higher education or for primary education, but there is a contribution limit of $2,000 per year per child, and there's an income limitations. So being able to contribute phases out from $190,000 to $220,000. In addition, if you don't qualify for an ESA, there's this account called the Uniform Transfer to Minor Account, or called an UTMA account. So this account is unlimited how much money you can put in. So you can put in $15,000, your wife can put in $15,000, I can put in $15,000 into the account for a child. But these accounts becomes the custodian's money when they reach the age of maturity. It's between 21 and 25. And so this account is a custodial account. So you as a parent will be the custodian for the money as a child. So that it doesn't have to be used for education. It can be used for a wedding, a car, a trip to Umrah, so on and so forth. So college planning starting early. So for about the cost of a fancy cup of coffee, how much is a Starbucks Frappuccino these days? $6, okay. Well, this is based off about $4.50. So if you took $4.50 for 20 business days, right, to say that every day you go to work, and you, instead of using out coffee, you invested that, by the time you reach 18, you'll have over $34,000. And this is at a 7% average rate of return. So remember that 7% too, because then at the end, you'll be able to compare that to some of the returns that the Amana mutual funds actually has historically. So So that's the 29,000. So there's other resources for planning for college. There is the ISNA.net has a scholarship that's financial aid. So please be aware of all these different resources when you're actually planning for college. So moving on, and one of the most important things is retirement. You know, I talked to my wife, and we talked about how do we make that trade-off between saving for college versus saving for retirement. And one of the things we get back to is that there's many ways to go to college. You know, my son can work through college. My son can maybe get an athletic scholarship or academic scholarship. But there's really not too many ways to for retirement. Like once you get to the age of retirement, there's no way to fund it. I can't get a scholarship for retirement, no matter how good my jump shot is. That's a joke. Okay, so during retirement, these are the questions that you ask. You know, when are you retired? The next 3, 5, 7 years. Where do you want to retire? Do you want to live where you are? Do you want to live in California, or do you want to come to Texas? Do you own your home? Will I have enough money? And so a lot of times folks focus on, okay, when I'm going to save this money for retirement, and then with retirement, I'm just going to spend this money. But in reality, the life expectancy here is getting longer. So when you think about people living in retirement, if you retire when you're 60, you know, the average lifespan for a woman in the U.S. is 85 years old. So that's 25 years in retirement. So retirement is not a 5 or 10 year journey. Inshallah, you'll have more than 10, 15, 20 years. And so the basic question when you think about retirement is, will I have enough money? Because no one wants to run out of money in retirement. So the sources of income in retirement. So the sources of income are personal savings and investing. Whatever you save up will be there, inshallah. Number 2, pension plans, which are more and more scarce today. Number 3, Social Security, and number 4, employment during retirement. So I'm going to ask you guys, what do you think is the average Social Security payment in 2020? About $1,200, pretty close. So it's actually $1,558 in 2021. So think about that for a second. So if you just waited for retirement and just the only thing you had saved up was Social Security, you would have $1,500 a month. You know, it's not peanuts, but when you look at average rent in places like Dallas, places like Atlanta, and metropolitan areas, this is not even going to cover your rent. And instead of just living, people want to eat too, you know, people want to travel, go to Umrah, so on and so forth. So we really need to think about retirement very seriously. So 71% of people intend to continue working in retirement. So think about that. Is that something you want to do? Is there other work you want to do, right? And a lot of people have to retire earlier than expected. So it would be nice to say, hey, I'm going to retire from this job at 65 and 70, but in some cases you're not having a choice. You might be asked to resign. It might be a layoff, so on and so forth. So this is one of my favorite charts. You know, Einstein said, you know, Einstein created the atomic bomb. He said that the most powerful force on earth is compound investing. And that's from the man who created the atomic bomb. And so when you look at this slide, it tells you 3 things. We're looking at someone who started saving $6,000 a year at the age of 25 versus the age of 35 versus the age of 45. So 10-year spans between each. The person who started saving $6,000 a year, assuming a 7% rate of return at the age of 45, at 65, at the retirement age, he had $261,000. Pretty good, not bad. But if you start that at 35, he will have $606,000, twice as much for just 10 years earlier. And if you start at 25, it'll be 1.2 million, right? So that the power of investing goes more to the people who start early, right? So one of the questions we ask is, when's the best time to plant a fruit tree?
As early as possible.
As early as possible. Anybody else? So the best time to plant a fruit tree was 15 years ago, right? Because you want to eat fruit now, right? But when's the second best time to plant a fruit tree?
No.
Right now, right? And so, I'll tell you what these two bars are. So the first one is someone who had invested $1,000 a year from the age of 25 to the age of 35, right? And the second one is the person who has invested $1,000 a year from the age of 35 to the age of 65, right? And you can see, and this is also at a 7%, that I forgot the time. Let me see. Okay. Yeah. So 35 to 65. So the one on the right invested less but longer. Only $1,000 a year for 10 years, but it was longer, starting when he was 25. So at 65, it would have $112,000. And the person who invested more and later is never going to catch up. So I know when I see this slide and I look at my age, I'm like, oh, should have started a couple years early. So now we're going to talk about a few different retirement accounts. So the first one is the traditional IRA account. The traditional IRA account, there's a contribution of $6,000 a year. The money is tax deductible when you put it in, so you get a tax benefit when you put it in. It grows tax deferred, so any of the dividends, the capital appreciation, you don't have to pay taxes on it. And then when you take it out, you have to pay taxes on it. So this is a very simple administration. This account can be opened in 30 minutes, and it's self-directed. And so the important thing is that you get almost complete options of what you want to invest in terms of securities. So you can invest in stocks, you can invest in sukuk, you can invest in bonds, so on and so forth. So one of the things about this traditional account, because I said I was going to talk about tax strategies. So one of the things is that at the age of 70 and a half, there's a required minimum distribution because you're putting in pre-tax and it's growing without tax. So the government wants to make sure that they can tax it at some point. So they're going to mandate that you take it out at 70 and a half. It's a required minimum distribution. But if you have other investments, it's not something you can also donate that to a 501c3 like your local masjid, right, and get the tax write-off. So you don't have to take it in, but you can also take it and donate it. So that's number one tax strategy. The Roth IRA. The Roth IRA is similar to the traditional, but the money does not pre-tax. So there's no tax deduction. The money grows tax-free. And then when you take it out in retirement, you can take it out and there'll be no taxes on it. But the Roth does have an income limit between 190 and 220. It kind of phases out how much money that you can put in the Roth. 190 and 220, filing jointly for a couple. And it's also self-directed, so you have your options of what you want to invest in. And if you're over 50, in addition, you can invest an additional $1,000. It's almost like a catch-up contribution. So they're employer plans. So when you think about employer plans, there's two main types. There's the 401k. Usually most private companies have that. And there's the 403b for educational institutions and nonprofits. And so these have a mix of options. So for example, your 401k might have a self-directed option where you can go into your 401k and they'll let you choose what to invest in. So you can invest in Amana mutual funds, you can invest in other Islamic alternatives. The tax deductible contribution limit for a 401k is $19,000. So you can imagine you can put considerable more money in than the IRA. And so now a few 401ks are having a Roth option, so you can actually put in money post-tax and then take it out without tax. In addition to the Roth IRA, there's a simple IRA. So a simple IRA is one of the things that we suggest for nonprofit institutions, right? And so you have two different options. You can either match your employee's contribution, or you can just say, I'm going to put 3% of their salary into the simple IRA for them. And the last one is a SEP IRA. The SEP IRA is an IRA for self-employment. And so it has a larger contribution. I think the contribution is $27,000 you can contribute for a self-employment IRA. So will you outlive your assets? So we talked about this. You can live 10, 20, 30 years into retirement. So if you're living, the probability for males, 20 or more years, and for females, the probability, so for males, if you live to 85, there's a 50% probability that you'll live to 85. And there's a 50% probability that sisters will live to 88. And there's a 25% probability that brothers will live to 92. So that's 27 years in retirement. And sisters, mashallah, 94, that's 29 years in retirement. So in addition to this, one of the things that we also offer at Amana Mutual Funds is an investment advisory service. So these are for people who have over $1 million in assets, and we're able to create a customized kind of financial planning and investing strategy for those. In addition to that, we also have a trust company where we can be a corporate trustee. And so in order for your desires and the fara'id to be taken care of when you pass away, we can take over as a corporate trustee and kind of execute your will. And so now I'm going to talk about the Amana Mutual Funds, and I'm going to talk about the Amana Mutual Funds. I'm going to talk about how we do our Sharia compliancy, and then I'm going to show you a few slides about our performance, and then we'll kind of go to the answers. So we have 4 different funds, and so can anybody think about this order that we have these funds in? Because they're not ranked from the oldest to the newest. They're not ranked alphabetically. Anybody have an idea?
Depends upon how aggressive you are.
Okay, exactly. They're ranked according to risk. So our top fund in terms of risk is a long-term capital growth. But it's not just long-term capital growth in the developing world. And so this fund was started in 2000. It's called the Amana Developing World Fund. Sometimes when the U.S. economy is slow, the markets can be taken off, and vice versa. And so this is a new fund that we opened in 2009. The second is our largest fund. It's the Amana Growth Fund. And the objective for this fund is capital appreciation. And so we invest in, it's kind of tilted towards healthcare and technology. The third one is our oldest fund. It was established in 1986. It's a Amana Income Fund, and the objective is current income. And the last one is our newest fund. It's called a Capital Preservation and Income. So capital preservation and income is that they want to preserve your capital, right? That's the goal of this fund. It's Amana participation because it's not investing in equities. It's actually investing in Islamic certificates, or called sukuks, which actually function like bonds. And so when you talk about Amana participation, when you're getting close to retirement, or when you're getting close, for example, if we take a masjid, for example, if the masjid has $2 million, they're about to build a new masjid, you might not want to put that in the growth fund. Yes, you get higher returns, but who knows what will happen in the stock market, right? It might go up 20%, it might go down 15%. If it goes down 15%, everybody's going to be calling me like, Hood, we can't build, right? So the Amana participation fund is going to preserve your capital. It's not going to have a high of a growth because you're not taking as much risk. And so that's the newest one. And, mashallah, we're one of the largest kind of sukuk funds right now. So Islamic consultancy. So to tell you how we do our Sharia screening, but first, we are, someone compared us to a halal restaurant, right? So you go to a halal restaurant, they have halal on the outside, but who really knows what's going on? So you almost got to take their word for it. We're not asking our shareholders and our customers to take our word for it. We are audited on a quarterly basis by our Sharia consultancy. It's Money Advisors, Berhad. It's a company out of Malaysia. And so they audit us on a quarterly basis from A to Z to make sure everything we're doing in terms of our Amana mutual funds is Sharia compliant. And so how do we do our Sharia screening? So the first thing is pretty self-explanatory, that we screen out for any business or the major line of business is something that we don't believe in as Muslims. So you can imagine that alcohol, pork, tobacco, gambling, pornography, so on and so forth. In addition to the business screening, we have financial screenings. So the first financial screening is how much debt do they have? Debt to the 12-month trailing market cap. And then we look at how much they have. The more cash you have, the more interest income you're taking. So we look at accounts receivable, total assets. And the last one, we look at how much haram revenues that you have. And because of the idea is that we're going to invest in a company that has no haram revenues, you're going to get like 2 companies, and they're going to be banks. So in terms of the scholars have to allow some room. And so when we say that, take a company like Southwest. Southwest is an airline, so it takes people from Dallas to Atlanta. But it also sells alcohol, right? And so we go in and we do our due diligence to say, how much revenue is coming from alcohol sales? And so any of the haram revenues, if they're over 5%, invest them. And 5% is a limit. So when we're looking at companies, we want to look at companies well below that target. We want to look at companies around 1-2%, and that's where our average is.
Where are these percentage bases based off of? Like?
That's a great question. So Mufti Taqi Usmani, he has a book called Introduction to Islamic Finance. And he actually gives the background of where these percentages are. So like why 45%, why 33%. So one of the things that we look at is that when you look at other methodologies, if you look at our OFI methodologies or other methodologies around the world, they don't change in terms of 33 to 45, but it changes is how you value a company. So if we look at the first screening, it says total debt to the value of the company. And so, for example, we look at market cap for a company. Another standard might look at total assets for the company. So that's where you're seeing a lot of the differences. But in general, there has to be kind of some kind of leeway for most of these screenings. So now, let's talk about some of the fun purposes for, I don't want to tell it who it is, but someone told me that they invested in the Amana mutual funds at $300 when they were in college. And so now they're a few years above college. And but for this to show someone investing $10,000 in our funds in 2011. So they invested $2,000 and they compounded. So that means they didn't take out any dividends or capital appreciation. Over the course of the last 10 years, they will have $49,000 or $50,000 for that $10,000 investment. And that's for our Amana Growth Fund. Our Amana Income Fund is $32,000. And so when you look at these numbers, right, one of the ways that you have to do when you invest, you have to have a benchmark, right? Because if I said, we invested $10,000 and now you have $15,000 after 10 years, that's great, that's $5,000. But what is the benchmark? What is the benchmark that you could have done if you were investing with someone else? So the S&P 500 or S&P total return is the benchmark on this slide. And the S&P total return looks at kind of the 500 biggest companies in the U.S. And you can see how they would do. So you would have 46,000. So our Amana Growth Fund kind of outperformed that. Our Amana Income Fund is a little less than that. Our Amana Income Fund, when you think about income and you think about these big companies, a lot of them are banks. And banks are one of the things that we can invest in for our income fund. And so that's one way you'll see a difference. So at our average annual total returns for the income fund, if we just focus on the 10-year return, the 10-year return was 12.5%. If you benchmark that to the S&P total return was 16%, and our Amana Growth Fund 10-year return was the average, 10-year average was 17%. So and so when you look at the amount of developing world fund, that 10-year average was around 3%. The developing world kind of had a really kind of lost decade in terms of you really didn't see a lot of capital appreciation. You cross the board, you can see that even the emerging market index, the index that we use for the developing world fund was 6%. And a participation fund is not 10 years old. It's right around 5 years old and has a 2.68% return. So when you look at that compared to the other funds, you're like, okay, that's not that. But the objective is different. the Amana participation fund is doing what it's supposed to do. The idea is capital preservation. And so we're looking for anywhere from a 2 to a 3% return for the participation fund. But the most important thing is kind of preserving your capital. So the last thing I want to touch on is, like, if you're investing with us, so when people call me up, I want an educational savings account or Roth IRA. So the first thing you have to decide is, what kind of account do I want to open? Do I want to open just a regular traditional account, or do I want to open a tax advantage account, a traditional IRA, a Roth IRA? But then the second thing, you have to say, which fund do I want to put the money in? So we have 4 funds, which is great because it offers diversification for our customers, but then it's also like, how do I choose? And so the Amana Fund Selector is a tool that helps you decide what is your risk tolerance, right? And what are your long-term goals? For some people, if they see their money having a 5% loss, they'll get really nervous. And be like, I can't sleep, right? So a fund that's taking a lot of risk may not be the one for you. And some people say, I really want a lot of capital growth. Then you have to understand that it's going to take some risk. So Amana Fund Selector, it asks you 8 questions, and it kind of goes to tell you about your risk tolerance level, and it's also your goal. So if you want, like for example, you said, hey, Hud, I want to invest this for the next 20 years, but at the same time, I don't want to take a lot of risk. That's when we kind of have a conversation that says, hey, when you're investing for the long term, it can be okay to take risks, and have that conversation to make sure that you're getting a kind of portfolio diversification and asset allocation that fits your needs best. So the last thing is that all of these funds have risk, in different level of risk. We'll send out perspectives that kind of clearly talk about the risk for the different levels, and there's no such thing as a guaranteed return. So definitely invest with caution. And that's our team. We have 4 regional managers. I'm the newest, that's why they don't have me up there, so we're not going to pay too much attention to that. So, right now we have some time for question and answers. So, and then I'll be here after questions and answers. Anyone want to call up and ask me something one-on-one. So.
When I was looking at the chart that was comparing the Amana Fund's growth versus the S&P 500, it didn't really. Did that also include how the expense rate kind of?
That's a great question. So when you look at our funds, when you look at our return on our funds, they're always net of the expense ratio. So that 12% return is net of the expense ratio. So yeah.
So it would be inclusive of that.
Yeah.
So Amana did outperform the S&P.
Yeah, exactly.
With the given the expense ratio.
Yeah. So if you look on here, right, the S&P is 16.6.
Yeah.
Amana growth is 17.2. So
Even with the expense ratio.
even with the expense ratio.
That's
From Islamic perspective, what makes Amana different? What makes it unique? You understand my question?
Yeah. Sharia compliant. Yeah. So one of the things that makes Amana unique, because alhamdulillah, there's a couple of options we have in our community now. But one of the things from Amana Mutual Fund, so Amana Mutual Fund is a trust, it has no employees. So they actually hire Saturna Capital, the company I actually work for, to kind of manage the fund, to take calls, to swing money, and to do the portfolio management. And Amana Mutual Fund was started by a group of Muslims who were looking for ways to not put money in a checking account and to get current income because they didn't want the interest. And so that was the purpose of the Amana Mutual Funds that it was started. So it was one of the ones that was started not for necessarily a profit motivation, to kind of serve the community. And so as we've gone, we had to first develop, like, how do you do Sharia screening? Like, what is the way that we know we don't want to invest in Anheuser-Busch, we know we don't want to invest in, tobacco companies. And so we kind of develop our methodology over time. And now we can look at methodologies like IOFI and other companies to say, how are they doing their equity screening versus us? And so I think that those are some of the kind of special things about Amana. I think one of the things that compliant is that we're all kind of audited on a regular basis. In order to be able to claim we're a Sharia compliant mutual fund, you have to have someone who's coming through, who's doing the work to make sure that everything's being happened in accordance with the Quran and Sunnah.
Is there a board of scholars that's auditing it?
Yeah, so the Amani investors, they are Sharia auditors out of, and Malaysia is like one of the kind of benchmark places for Islamic finance in the world. I actually did a year studying Islamic finance in Malaysia prior to almost 10 years ago. Sisters, any questions? Don't let the brothers take up all the questions.
You mentioned the book when you were talking, if you want to learn more about Islamic finances and how investments work. What is the name of it?
It's called Introduction to Islamic Finance. So I actually have a PDF copy. If you take my card, I can email you a PDF copy of the book. And so Chief Justice Tucker Usmani is like the kind of, visionary educational leader, thought leader of Islamic finance throughout the world. And so he's a Chief Justice of Pakistan. He might be retired now, but he's not. MashaAllah. He still teaches. And then he wrote a book a long time ago called Introduction to Islamic Finance. It's almost like the seminal book on Islamic finance still to this day.
You talked about compounding, and I know little about the magic of compounding, but is that compound interest as long as you're investing in a company that has a halal revenue or haram revenue less than 5%?
Yeah, so when you say, usually they talk about compounding interest because they'll talk about if you're buying bonds but compounding really means that your investment, like even if you're buying an equity, if you're buying an equity that pays a dividend, so it's not an interest, and then you put that dividend back into your investment, so it's buying more of the company. And then if there's capital appreciation, you're putting it back more. So the compounding, we use compounding investment because we're not investing in interest-bearing bonds. We're investing in equity securities, and so you're reinvesting any kind of money that you make in the meantime. So that's why we say compounding investing.
What are the other Sharia compliant trust funds that are out there aside from Amana? If you don't mind me asking.
You want me to tell you our competitors?
I mean, you gotta see the whole thing. You don't mind me asking.
Definitely. No, there's a Sharia portfolio.
Chef Joe recommended Amana. That's what I'm just curious.
No. We were just looking at that. There's Sharia portfolio. There's Wahid. Wahid is one of the things that they're doing now is they're having Islamic ETFs. So an ETF is exchange traded fund. And so one of the things about ETF is that it's not actively managed. So basically a computer is picking all the Sharia compliant companies and just buying them. And if one of them like say their debt to income goes up, they'll sell it, and then it comes back down, they'll buy it, right? So there's nobody who's actively kind of managing the portfolio. And because they don't have an active portfolio manager, so sometimes it has a lower expense ratio. And so when people compare us to ETFs, they will say, oh, well, your expense ratio is higher than some of the Islamic ETFs that are coming out.
Because of higher returns?
You can check the returns. I think we're high. Everything's changing. But one of the things to notice is that we go to companies for different reasons. One of the things that I think Amana has that you won't see across the board is that we have better customer service anywhere, right? For example, when you call us, hello, this is Hood. Like it's not an IVR machine. It's not Fidelity. Fidelity is huge. When you call somebody to get someone, they're transferring you around to different companies. So we are very strong, and I've been investing with Amana for the last 20 years, even though I've only worked here for the last 4 months. We have those regional managers who are actually going out into the community, giving presentations, giving this education, because I promise that the most important thing is when we talk about saving and investing, this is saving and investing in any company, any mutual fund, any ETF, right? We're one of the options, I think we're the best option, but we're one of the options. So that saving and investing is one of the most important parts. Oftentimes, we'll do presentations and we'll leave out the last couple slides, but you know, I like showing slides where you see a 17% return. So it's a nice.
Yeah, any investment involves risk. So what's the probability of a loss, you know, when you use such investment?
Yeah, definitely. And so when you talk about the probability of a loss, you know, one of the ways that I think this is the best slide to talk about that. So, for example, look at this 10-year return of 17%, right? What was the return for last year? Someone could read it. What was the return for last year?
1 year?
Yeah,
29%.
29%. So that 29% is really high, but the 17% is less than that. So there were some years in there where there were some down years. And even when you come back to this graph, you know, you see, remember this for all the people in the market? You remember that dip? Everyone had a dip, right? And so you'll see that, you know, there's up and down years, right? So there is a probability for loss. Anytime you invest money, there's going to be a probability for loss. Even the participation fund. But the participation fund, you're going to see it more steady because it's, you know, the idea, the objective is capital preservation.
I'm gonna put this here. Anybody who wants to leave his name before you let me know.
Okay, definitely.
What about this 5 to 9? Is that the best for kids for college?
Yeah, so the 529, so we offer an ESA at Saturna because it's almost like, it's called an educational IRA. The 529 plans are state-sponsored plans. They're very advantageous because there's no income. You can make whatever income and you can put how much ever money you want in. But the only downside for Islamic investing is they usually have very few options. So sometimes they only have a target date fund. So for example, if your child is 7, they'll give you a 11-year fund to kind of get to when he's 18. And when those target date funds, as you get older or get more closer to those times, it changes from equity to bonds. And bonds are usually, you know, impermissible. So that's the kind of downside for the 529s because you have less choice. So when you have less choice, there's less opportunity to make it personal.
You mean less choice in terms of?
Yeah, less choice in terms of what you invest in. Okay. So the IRA, you have more choices. 401k, you can.
The ESA is known as what the?
Educational savings account.
Okay.
Yeah.
Is that something called the Cordell?
Yeah, Coverdell.
Coverdell.
ESL, yes, exactly. And we have a pamphlet about our ESA
So
program.
in that investment, what do you have to do to start it up? I mean,
Yeah, so the application is probably about 20, it takes 20 minutes. You can do it online. It's a $2,000 contribution limit per child per year.
Oh, so you can contribute more than that?
No, you can't contribute more than that, per child per year.
So then you guys take those funds and invest it in different places for it to grow?
Yeah, exactly. So when you do the ESA, then you also have to determine what fund you want to invest in. So for example, if you're
So
thinking
then
about,
it'll be from less aggressive to the most.
yeah, exactly. So if you think about your 2-year-old,
Right.
you might say, hey, let's just be aggressive. But if you think about a 15-year-old, balance that.
Yeah, but I had somebody asking me this in a group today that is 529 Sharia compliant. I said, I'm not the authority on that.
Yeah. Like most 529 plans have very few options. Like the state gets to pick the options. The state might give you 2 or 3. Usually the state is not. Yeah, 2 or 3 funds or bond funds. So they might.
ESA, you have more open options.
Yeah, exactly. So ESA, they might say you can have a large cap growth or large cap income, medium cap.
Right.
So you have very few options. So that's.
Anybody
Yes,
from the
not like-
sisters, questions in the back? No? I think they know everything. They
What
know.
about the, so I know you mentioned about the 529 and then the ESA. What about that UGMA?
Agma or Atma, right? So this is the count, there's no contribution limit, but if you put in more than 15,000, you might get in trouble with gift tax. So there's a gift tax up to $15,000. But you can put in 15, your wife can put in 15, your brother can put in 15 for your child. And so you're the custodian, the money's for your child, you can use it for whatever, you can use it for their college, or you can use it when they get married. But at the age of majority, right,
It becomes theirs.
it becomes theirs.
Oh,
But technically, they might not know it's there, right? It might be. But, so that's the thing about.
And what's the difference?
And the only other thing is that when you do the USMA, when they fill out the form for college, it's looked at as their money versus the ESA is looked at as parents' money, and those kind of weight differently in the financial aid application
If
process.
you intend to take your contribution out, is there going to be a penalty for that?
Oh, for which one?
For ETLs?
For the ESA?
Yes,
So the ESA is tax deferred, but then when you take it out for educational expenses, not just tuition, not just room and board, you could be buying a computer, you can pay for parking decal, books, there's no tax on it. So, like the Roth IRA, when you take it out, there's no tax on it. In addition, like for the Roth IRA, there's actually 5 reasons that you can take money out of your Roth IRA and not be taxed on it. You can take the principal that you put in any time out. So a principal that you put in, you can take that out any time. But the earnings, you can't take unless you'll be taxed. But if you are disabled, if you're retirement disabled, you've had your medical expenses, you're buying a house for the first time, or you're paying college for anybody in your immediate family. So a Roth IRA can be a vehicle, right, to save additional money for education as well. This is a good question.
All right, so if nobody has any questions, we can head over to the grill and to the food, and we can mingle and ask questions doing that. Is that okay with you?
Excellent.
Yeah. So you can ask questions on a full stomach. That way you know what to ask. Yalla. Yes, sir.
Y'all will support the Islamic Mesquite, Appointing
I'm sorry?
Islamic Center.
What about it?
Well, the support has been open for about a few months, and we want you to support it.
Okay. Do you have any questions in reference to this topic discussed tonight? Okay. Other than that, inshallah, so we'll at the grill. It's going to be in the back. So go out there and enjoy, inshallah. Jazakumullah khair.
Appreciate it. Thank you.
Yes, sir. Yes, sir. Okay. Beautiful. Beautiful. Interesting. Very, very, like, it's probably my first time sitting in finance.
Hopefully it wasn't
Yeah.
too boring.
No. It's a lot of wealth of information, yes, sir.